Hi everyone and welcome back to Stephan Livera podcast, brought to you by Bold, the Bitcoin banking platform where US listeners can buy Bitcoin for the industry's lowest fees and earn the highest Bitcoin back rewards with the Bold debit card. Now joining me today is Kane McGukin in wealth management, obviously also a Bitcoiner and hodler for years. Actually, Kane and I have been chatting in the background here and there for a little while, but I thought Kane had some interesting thoughts on the Treasury companies, and he published that on his Substack, which we'll put the link in the show notes, but it's called The Mesh Point, so you can find Kane's work over there. First off, welcome to the show, Kane.
Yeah, Stephan, thanks for having me. Really appreciate the opportunity just to come on and talk about the space, as lots changing, lots growing, a lot of questions up in the air. I know you and I have talked in the background for a few years, met a couple of times at different conferences, so it's good to be on and looking forward to the conversation.
Sure. And so, the big, topic for today is going to be around some of your, let's say, skepticism of Bitcoin treasury companies. And I guess just to be clear, we're talking about the financial engineering style as opposed to quote unquote merely hodling or merely just, buying. And I guess just upfront again, I will just say I am going to be an advisor and an investor in a treasury company that's not out yet. It's in a non-US jurisdiction, so things will be going more public there in probably a few weeks there, but I'm just saying that up front so listeners can understand. Okay, obviously I have some interest in this. I'm bullish just in general on treasury companies, but I will agree obviously that it's not without risk. There are risks, absolutely, and I will say that people have to be clear about self-custody Bitcoin. I think is first and foremost. This play of if you want to do the treasury company thing is sort of, I view that as that's like a small aspect of what you should think about. So I'll just put that up front just so people understand, and I'm not hiding things. And so let's start. Do you want to give us your overview? What's your kind of, hit us with your opening argument on treasury companies?
Yeah, and I think to put that into perspective, obviously, good for you to get that out there. You kind of have to these days. Look, I've bought some of these here and there, hold a little bit, MicroStrategy. I think a lot of people do. So my skepticism is not so much of, hey, this whole thing is a problem or an issue. I think, you've been in this long enough to see every single cycle is different yet the same when you get into the bullish most bull part of the cycle. And some narrative, some individual usually takes hold as sort of the godlike feature, creature.
The main character.
Yeah. And, something just rallies everybody. Last cycle, it was the GBTC arbitrage trade. You're seeing some of that in this hype. And so my thing was just looking at this and, okay, fundamentally, what's important about these treasury companies, what's important about the underlying asset, what's important about the future of Bitcoin as it kind of marries with TradFi. And so when I got looking under the hood, I've been a student of markets for a long time, been in them for 20 years. My first handful of years, I really dove down deep into the greatest investors of our time, the Soroses, the Paul Tudor Jones, Paulsons, all those guys, and having gone through 2006, 7, and 8, it sort of, you start to see these things come up again. And so that was kind of the basis. Is fundamentally, I think Bitcoin is phenomenal. Bitcoin is the innovation. I think with treasury companies, and to one of kind of your side questions, do you think they survive? I think components of this do survive, and as long as Bitcoin sort of stays in its own ecosystem, and then traditional finance stays in its own ecosystem, then marrying them together is the way that we move forward. Otherwise, it might take too long for regulation to catch up with where Bitcoin's trying to go. So I think it's kind of a bridge. I'm less on the front, and we can talk about it a little bit more, that it's just some amazing new innovation. Like that is the Bitcoin piece, and what's going on in the treasury company is just kind of bending what is easier to fulfill those investors that can't access Bitcoin because of, covenants or legal or just, time to get it through investment committee. So hopefully that sort of explains it.
Okay, so let's so let's try to nail down a little bit, like, where exactly do you think things might break down? Who exactly gets wrecked? Like, are we talking that, many of these treasury companies will, collapse? Or is it more like some of the treasury companies, you think they will actually survive, but maybe the equity holders are the ones who get wrecked? Just like, Bitcoin holders in past cycles who bought the top, are they the ones who get wrecked? Like, where exactly is the failure in your view?
Yeah, I think it's on the way that the hype is being created around these. And that is the equity issuance. So last night I was just digging in because I hadn't really done the math on it, but I think MicroStrategy has somewhere around 300,000 shares outstanding now. It's either 295, 311, maybe a little higher because they issued some of these this past quarter, but they only had 150 or so just a few years ago. So not thousand, but million, 150 million. So you've doubled your equity, which is dilutive to equity holders now, because they're taking that and taking, per what Saylor says, 50% buying Bitcoin, 50% using it to pay dividends or issue other securities. That's the leverage, right? And so leverage can be done well, and it's a good thing. But when you have what happens on Wall Street in traditional finance, you have this trade, this arbitrage on the equity side. And then a lot of other people start piling in and capital starts piling in. And so it goes up until there's really no room left. And then either you have one failure who accidentally did it wrong, didn't really understand it, or a big investor pulls out capital from not just this situation, but in a situation where you get a crowded trade and it starts to work in reverse. And so I think the biggest risk that I see is just that equity dilution to feed this other stuff. And so you see a lot of the winner take most. And I do think that'll play out. But if you look at the last two cycles, or last cycles, MicroStrategy started in the beginning of a bull. And they still had the 70, 80, 90% drawdown. As a person that's been in Bitcoin, you yourself been in Bitcoin, that's the thing that's unique about Bitcoiners is they sit through those. But traditional financial people don't. So they usually punt when it's down 20 or 30 because they say, I've got to sit through this for 2 years or 1 year or 3 years, and that's painful on there. And so to me, that was just the place that I started looking. There's a lot of other ways, but I'll take a break there and let you jump in.
And so when you're saying, okay, and I mean, as far as, I guess I partially agree and partially disagree, right? So where I agree with you is, yes, there is a risk equity holders get wrecked, especially if there's a big bear market, right? Like a Bitcoin bear market and the equity bear market, you can be double wrecked.
Yeah.
Okay. So I see that as, it's higher risk if you are merely the equity holder. But I think the important thing to understand here is that even in the case of MSTR, they have gotten to the level now where they have these preferred shares, so Strife, Strike, Stride, and Stretch, each offering different trade-offs and each offering different kinds of things. Like some of them are paying, $8 a year. Some are paying $10 a year. Some offer some equity upside. And Stretch is quite interesting as well. That it's like a quasi stablecoin paying out. I believe they're targeting 9%. So, do you not see that as... Yeah, go on.
No, finish up.
Yeah, so I guess my point would just be, isn't it interesting then that, not everybody has to be a direct MSTR equity holder, like riding the full volatility. They can be kind of holding one of these other preferred shares. And in that way, like the analogy that Michael Saylor uses is this idea that it's like he's kind of taking the high voltage Bitcoin and stepping it down for these different investors who maybe they are not willing to kind of ride the full volatility of a full Bitcoin cycle. And therefore, he is sort of structuring his balance sheet to survive, in different conditions, whether that's an 80% drawdown or whatever, which personally I think it's unlikely. Of course, it's possible, but I think it's unlikely.
Yeah, I think it's different this round with Wall Street very much and banks very much involved. I do think it's lower. Yeah. Because there's a lot of capital to support a bear market, whereas in past bear markets, when it was primarily retailer or smaller investors, there just wasn't enough liquidity to come in to put a floor in it. Yeah, and I think the beauty behind the whole thing that Saylor's figured out, the arbitrage, is Jesse Meyer's picture. You know, if Bitcoin's 2
Right.
trillion and you have 300 trillion of assets, many of them impaired because of what's going on in dollar land. In a sense, you know, we often talk about orange pilling. Instead of doing the hard work of orange pilling, he's just like, I'm going to go meet you where you're at. I have this public entity. I have equity. I have the ability to issue these other things that I know you can buy, even if your investment committee says no Bitcoin. We're not technically buying Bitcoin, right? We're buying an equity or a preferred that pays interest just like any other bank preferred. So that's the genius behind that move. So where you might have some separation is, okay, you've got a Bitcoin Treasury company that can't yet issue preferreds. And the equity games kind of played out, which if you've seen the last couple of weeks, many of these post-conference kind of late May timeframe, they're down 60, 70%. And then you see some of them down 30%. And in fairness, that's a snippet in time, right? Because you can go back and see. But you'll see ones like Similar or GME that never really launched it. They sort of created that flywheel and just never really did anything. Their stocks are only down 20 and 30% because they have actual businesses outside of the Treasury. So they have income and revenue streams that aren't just Bitcoin. And then you have Saylor and MicroStrategy, which in reality, he's, in my opinion, setting up the 21st century bank. And so he's sort of using the tools to do the Bitcoin lending because there really aren't all the rails to actually do the lending in Bitcoin terms yet. And that would be the innovation piece. So if I go back and say, like Stretch, for instance, are you familiar with Auction Rate Securities?
I would say
okay. Okay. So when I came into and I was just a general question, I don't think people are, just like people aren't as familiar with preferreds. Those are standard tools. Now, Auction Rate Securities, I came in the business in 06, had a big insurance company, and they would do these, they were 28-day, they had 7-day, they had 90-day, and they paid a much higher interest than just Fed funds. So you'd roll them. And I was young. I didn't really exactly understand. It's just now, okay, we're doing 20 million, we're doing 50 million, we're doing 10 million every couple of weeks. And it was 2007-08, stuff was getting hairy. For whatever reason, I forgot to do one. And the guy calls me and chews me out. It's like, do you know how much that cost us? Because it's, whatever, 7 days worth of 6% on 50 million bucks. And he kind of just, lets me have it, rightfully so. Well, that was the last auction that didn't freeze. And so those investors that were chasing that yield in this product that was money good, because it was municipalities, other issuers, that daily interest, the dealers, it was a bidding market, a Dutch auction. And so that market froze and they didn't get their capital for 2 years. And some of them just lost their money. So Stretch, in a sense, is an auction rate security. And strategy is effectively playing the role of the dealer, setting the rate. There's no market participants bidding. But what tends to happen in securities is, analysts rate the stock and they just will let it run. And that reflexive nature that I wrote about in the report that Soros talks about, where it's allows a security to trade away from its actual fundamental value. So if we talk about MNAV being at 3, well, NAV, that the actual book value of that Bitcoin is 1. So if you're buying an MNAV of 3, you're technically paying 3 times the price of Bitcoin, right? So if I'm a Bitcoin investor and for whatever reason I just decide to go all in a MicroStrategy or some other, Bitcoin Treasury company, I'm paying more than I should. Now, I don't have to deal with self-custody. I don't have to deal with all that. I don't have to deal with money on a different set of rails. And there are some people that fits for. So that's kind of the argument. A lot of the instruments that are being issued are just the same instruments that we've seen in other places. And on the preferred side, so in February 2020, February, March, everything blew up. So we were looking at some preferreds for investors, and generally it's banks. There's some energy companies. It's a better way to find yield that doesn't always get picked apart when rates go crazy. And you can do, while rates are rising, you do floaters, so they have floors, and the interest rates rise with it. Whereas a fixed income fixed preferred, the rates will get crushed, or the price will get crushed as the rate rise. So there's some unique characteristics there. But we were looking at some, compiled a list. There's not a lot of these things out there. And they fell 30% in one day. So while you're looking to kind of extend a little bit to take some risk to get that extra yield, so strategy 8, 9, 10%, anything over what the base rate is in this market's Fed funds at 4.5, that's 100% risk that you're taking. So it's not inherently bad. It's just not a guarantee. And I'll stop there. But in the quarterly call that the strategies just did, Saylor, he basically used the exact example of what's happened with Strike, Strive, Stride, and not really Stretch because it's just coming out, but those in just the last few weeks. We can go over that in a second. But
Right. I think what you're getting at is this idea that was actually part of why they structured Stretch this way, because he was saying that there may be investors who might have otherwise been interested in like a $10 yield or an $8 yield per year, but they wouldn't have been able to, like on the income side, but they might not have been able to tolerate the capital value swings up and down.
Correct.
Some of those preferred shares, Stretch, Strife, and
or
Stride.
just an income product.
Sorry,
in
non-stretch,
general.
the non-stretch ones, because just as a factor of like bond math and like when the yield moves and the price moves, that factor. So I guess that's what they were trying to, let's say, target and say, okay, now with Stretch, we're going to try to give you like the capital value is going to stay the same, and that's why people sort of say it's kind of like a quasi stable coin, sort of, but kind of a stable coin that you would access in your broking account, not as like a tether on whatever other chain. And so I guess that's the point you're sort of getting at, right?
It's like a repo. So if now, you and I, Bitcoiners for a long time said, hey, the dollar's not really worth it. People are because all that backs money is trust and belief. And we're seeing globally where that trust and belief that was in fiat dollar system, regardless of currency, is sort of breaking down. So in a pro argument, Saylor said, well, I have this pristine collateral and a lot of it, but I can't do anything with it. It's just literally HODL. Now, that's good, but to create financial services, you have to create an arbitrage or find an arbitrage so that lending can take place. And so he's like, well, I know that there are a lot of corporations, pension funds, hedge funds, endowments that need daily liquidity because they might could park 10, 20, 30 million overnight, but then they may need it for something else the next day. And usually that's like a corporate treasury function. So, okay, well, that happens in commercial paper, in the junk bond market, in the treasury market. But now if people are kind of losing trust in that, and maybe they trust Bitcoin and strategy in general more, that's kind of the environment, then he's able to create that product. So that particular product, I'd say, I don't know them super intently, but I've looked at all of them. Stride, for instance, Bitcoin selling off, everything's selling off the last few weeks. Well, Stride was kind of the canary in the coal mine because it started selling off harder. It had a higher yield, and I think it's non-cumulative, which means if they stop paying, you're just out. And so in that February example, I've owned some of these things personally just in the past where they were backed by mortgages. It was Invesco preferred, great preferred, 6, 7, 8% yield. things got hairy in 2018-19, and there was a question to the value of the underlying collateral, which was mortgages, and that thing got hit 50% overnight. And so why I'm more skeptical is generally because you're dealing with high net worth individuals, and while the risk sounds good, if they, and this is the example that he gave on the call, you know, a 50, 60-year-old or 45-year-old that needs income, they really also need that principal to remain. So if you put $10 in and you get 8, 9, 10, 11% yield, that's cool. But if you go 13 months later and you got basically 10%, but then that principal, that $10 that you put in is now worth 6 or 5, that kind of impairs a longer term. So that's the risk that we get caught up in with all the hype, is chasing that yield, not realizing how the impact is in price when the markets move. And so you're seeing that in some of those.
So I guess what you're basically making this argument that the non-stretch preferreds could really, the capital value of those could really move a lot, and that a lot of the holders of those may not be really or ready to kind of ride that level of volatility compared to like a hardcore Bitcoin hodler who is ready to kind of ride the cycle down 60%, 70% if necessary. That's probably, maybe there's something to that, but I think the other thing we have to kind of also remember is it does center on what is your view of Bitcoin's growth, right? Like Michael has his, Bitcoin 24 model that basically he's projecting, I think his base case is like $13 million in the year 2045,
like
something like that.
29% ARR.
Yeah, right. So call it 30%-ish or 29%, whatever. And so if you're a maxi, if you believe like Bitcoin is the future of money, and therefore, the longer run price of Bitcoin is going to be in the tens of millions of dollars, then are you not also, now I'm not saying you must buy strategy or you must go and buy Bitcoin treasury companies, but isn't it kind of hard for us to make this argument, or for you to make this argument that, these treasury companies may not be sound if they are able to access capital cheaper than Bitcoin CAGR and buy Bitcoin with it, right? What do you think of that?
I think that the real point of the argument, for argument's sake, is what's every person's time horizon? Yeah. So just like Saylor said in his call, a 50-year-old or retiree, their time horizon is very, like year to year actually makes a difference. So chasing that extra potential upside could impair them more to the downside in a window when so if you're taking out money and you have a 20, 30, 50% drawdown, you actually are doubling the amount that's coming out in the worst period. Whereas if you take out excess in 100% rally, it's kind of indifferent. So timing really matters from that perspective.
The lead sponsor of this show is Bold, the banking platform designed for Bitcoiners. With the Bold virtual Visa debit card, you earn Bitcoin back on every purchase. The more Bitcoin you buy with Bold, the more sats back you get on the card. Buy $2,500 of Bitcoin and earn 3% sats back. Keep stacking with Bold to earn up to 10% sats back. Bold offers the industry's lowest fees on Bitcoin buys and sells with zero added spreads. When starting out, you can use Bold Wallet, which is managed by the team, but Bold is also supporting self-custody with Bold Vault, a 2 of 3 collaborative custody multisig for zero monthly fees. With Bold, you get your own FDIC-insured checking account to store and send fiat, pay bills, direct deposit your paycheck, and replace your legacy fiat bank. Sign up today and get zero fees on your first $10,000 of Bitcoin buys and $25 of free Bitcoin when you buy $100 of Bitcoin or more. Go to getbold.io. This episode is brought to you by CoinKite, the makers of my favorite Bitcoin hardware wallet, the Cold Card Q. Now, some people think self-custody is too hard, but it's really about taking responsibility for your Bitcoin wealth and understanding that self-custody gives you a true feeling of liberty. The Cold Card Q has a full keyboard and big screen. It's got 2 secure elements and a true air gap, allowing you to go fully air-gapped using QR codes from seed generation to transaction signing. You can power the device using 3 AAA batteries, so you don't even have to plug it into the wall for power. You can easily use it with Sparrow Wallet for PC or Nunchuck on mobile, and you can dial it into the right level of security and complexity that you choose. If you want a simple setup, just use 12 words and single signature. If you want passphrases, easy. If you want to add multi-sig or co-signing features, you've got those too. So go to coinkite.com, use code Livera to get 10% off on your Cold Card or other devices and level up your self-custody today. I mean, I agree with you on the timing aspect of it, but I think that to me is kind of like, even imagine if we were talking to our family and friends and it was earlier Bitcoin cycles and, it's 2017 and the price is, 16K and it's the end of 2017.
Yeah.
We're about to hit the top.
Yep.
There were a ton of, noobs and no coiners who bought their first coins, whatever, 17, 18K in that run.
Yeah.
How is that any different,
Well, and it's not. It's just the hype around it. So that's what I pointed out in the article was everybody's like, oh, this is something new, it's something new. And, Soros talks about it a ton in The Alchemy of Finance. And it's the reflexivity that creates the newness, that creates the value to run away from the fundamental value. But we've seen the exact same thing in the 60s conglomerate boom, where they made up a bunch of new statistics, new stats, MNAV, it's book value. You just did a different way to calculate it. Bitcoin yield, same thing. They were doing the same thing as a means to buy up companies, and buying up those companies would make the EPS multiple grow. And then, he walks through a case, and I put in my paper, well, Strategy actually put that in their quarterly call just the other day, where it shows because of the accounting change, they got an instant hit to their EPS. So they reported like $32 in EPS. And because of the accounting change, you can account for the growth in Bitcoin, which makes all that math look much stronger than it really is. It's not that Bitcoin's not strong, but if you go in a year and a half and Bitcoin's down 50%, all those numbers cut by 100%. And so one of the other fundamental things, I think they said they have like 614 million of dividend interest expense. So that could be preferreds, that could be whatever these securities that they're issuing that have to pay interest on. Well, okay, so they could pay that forever with the Bitcoin stack that they have realistically, even if you cut it in half. But the operating business only does 200 to 400. So they're having to issue securities to fund that debt liability. So to put that in perspective, I think we can all agree that we have to have self-service, right? And so American Tower, Crown Castle, Verizon, any provider, that's a huge infrastructure business, but they're effectively Bitcoin rails for voice, right? But if they have to take on 5x, 10x debt to support that, most people walk away from that, because what ends up happening is if something goes wrong in the business and you can't issue new debt, then you can't pay that interest. And in a lot of ways, that's what the Fed does. They issue new treasuries, so new money, or the Treasury does it. They issue new dollars to fund interest in debt that they can't otherwise afford. So I think not really skepticism is kind of my rub. It's Bitcoin will and was doing its thing, but now we're sort of taking what everybody hates about the Fed or complains about the Fed and putting it on top of Bitcoin.
Yeah, I think to me, it just comes down to, is this a way to make Bitcoin accessible in ways that were not previously? So when it comes to like, okay, are they issuing new securities to, etc.? I think, I guess what I'm thinking of here is more like, if you think back to that recent earnings call, I think someone actually asked, I think it might have been Lynn Alden asked the question of like, okay, have you kind of run stress testing exactly what kind of drawdowns? And I think he said even at an 80% drawdown, they would still be paying out the dividends. And I think only at like 90 or 95%,
like 95 what they had
is where they would have to start pausing certain payments. And so, to me, maybe, and okay, fair enough. Maybe the risk is not MSTR. Maybe the risk is some of the smaller treasury companies. But to me, it's just, we also have to balance that against the other aspects of this, right? The tax, the regulatory aspects of it. Are there, for example, in Japan, where there's like a differential tax treatment, or in other countries where that may be the case, or the kind of regulatory requirement, right? So I think in the UK, that's the kind of the smarter Webco, Coincilium examples, where there are people who have UK retirement account money that's gone into MSTR or now smarter Webco and whatever, because of those reasons. So I think it's a bunch of these things. It's the regulatory and tax thing. It's the index inclusion. It's kind of offering a different trade-off.
Yeah.
Right. So I think while it is certainly not a bad thing to have like a retail kind of advocate community, let's say, I think there would just be reasons that it makes sense for people to invest in these things. But yes, the timing matters. Yes, there is a risk. And it's higher risk than just, holding in your cold card, right? Or the way I think of it. But can it offer you different trade-offs, or can it, because I think the other thing that we sometimes run into is like, we're in our little echo chamber of like, hardcore Bitcoin maxis and people who are like, diehard about Bitcoin. And we think it's just so obvious to the rest of the world, but it's really not. There's so many people who don't even understand. Like, they might have heard of Bitcoin, but they might not really understand what's going on with MSTR. And then if they don't even know what's going on with MSTR, what's the chance they know what's happening with like MetaPlanet and Smarter Webco and all the other ones, and just kind of all around the world? And I think these are just ways. I think sometimes we don't mentally model what normal people think, because normal people are just sort of like, they might be having most of their money in some stockbroking platform, and they can sort of see, oh, wow, this, whatever, Alt BG or the Capital B in France or whatever, one of these other ones did really well. Maybe.
So that's, so that's where, like, because that's my day-to-day life. So I'm in the traditional wealth management side, trying to orange pill normies who they have wealth. So they're concerned, while in the near term, it might be like, how do we hit a home run here? But then when you try to hit a home run and you get, a negative, they're like, well, why did we ever do that? And it's because you're chasing what you hear on CNBC without thinking about mechanically how it works. And so it's hard to get traditional people to buy Bitcoin because of all the trade-offs, right? I can't just buy it my Schwab account, or I can buy the ETF, but it's not really
right. But you're paying fees on that. Really, it doesn't have leverage. It's a different trade-off.
Yeah. And so when you see that, plus just being in the business decades, and personally, I'm interested in all these things, so I'll go do them. And if you take a haircut to myself, that's okay. But if you do that to someone else as a fiduciary and you just let them run blindly into, get the phone calls, let's buy MicroStrategy at 550. Okay, well, it's 395. Well, my buddy that told me he's made, 8x in MicroStrategy and we're lost, it what it ends up reflecting back on is us, more so than understanding the mechanics. Because when you talk about the mechanics, the normal person's like, dude, can we just buy this thing or not? But they tend not. There's this idea that you put money in the market and it goes up.
Yeah, of course. And I think the Fed and kind of the institutions, like the setup has just been that way, right? Like it's just been buy the S&P and just go
close
away
your eyes.
And just wait 10 years, 20 years, 30 years and you'll be up. That's kind of that's been the message, right? And sadly, a lot of people are getting kind of wrecked without realizing it, because inflation has actually been debasement, let's say, to be more technically precise, right? It depends how you count this number. But if you look at like Matthew Mazinskis' work, Paul
I had him on the podcast. He's awesome.
Right. And so if you look at his work, it's like 12% a year. Yeah. Okay. It depends how you count that. Maybe just in the US only, it's 9 or 10%.
Even better, And a lot of people don't do it, but just collect your grocery receipts for a couple of
Right.
years. It's closer to 20.
Right. Right. And that would be more like the CPI aspect of it as opposed to the asset inflation side of it.
Yeah.
But certainly. And so I think sometimes we miss the forest for the trees then if we're sort of nitpicking about like, oh, people could possibly theoretically get wrecked if they timed it wrong.
Yeah.
Certainly. I grant that. But don't forget, people are getting wrecked right now. They're putting all this money into government bonds. They're buying all these overvalued equities. They are just buying, S&P 500 blindly because, knowingly or unknowingly, that's where the retirement funds are just funneling their life savings. And so now, whether it's Bitcoin ETFs or Bitcoin equities, they've got a fighting chance, don't they?
Yeah. Well, and I think where I like to talk to is like, hey, before you go to a Bitcoin Treasury company because you can get leverage, you should own some Bitcoin first. You should understand that component, because if push comes to shove, and let's just say I was right, like Bitcoin will still be around, but those assets probably get torpedoed, right? Other than first movers, there's that brand advantage. Strategy here has a huge size advantage. They have an expertise advantage. And a lot of times when you get into these crowded trades, it's the same exact setup happened in GBTC. And every influencer out there was like, you can do 40% a year rolling. And I was like, it's just covered calls. And while that sounds cool, because you did it in a 3-month window and you did it 3 times, one, it's not annualized. 2, it's not repeatable. And when you're collecting, 8 to 16% up front on the premium, and the asset drops by 50, it takes years to come back. And you can't write any more calls effectively on that. So there's some, validity to that same hype for these things. Now, to me, in a bear, well, first thing is the last bear, and I'll just use strategy again, they did actually have to move some coins around because they had some secured, debt issues, and now, everything's unencumbered, so it's a much safer situation. But there was that you could go and see. I think I looked it up. May not be the exact number, but I feel like there was 700 coins or something that had to move around. And he mentioned it on his podcast with Safe in the spring. And so I think they're kind of that winner take most, but some of these others that maybe are taking more risk than they realize because maybe they hadn't traded options that long. And the equity is the option piece. So you need that flywheel to create that MNAV to fund everything else. And then what they've done, which is, I do like it. We don't have a Bitcoin yield curve. You can't have a financial ecosystem if you don't have a yield curve. So he's sort of building that. It's not direct because it's still just a FX sort of ARB where you're borrowing in the cheap currency, in this case dollars, and you're buying the strong one, which is the same thing that happened in the yen dollar carry trade. There's lots of different ways to do this. Happen in the Treasury market now, where the hedge funds are just arbing for 3 basis points. Here you just can do it for a large percent in size. So there's some stuff that is interesting. I do think it sticks around. I just think probably what really clued me into it was, so I look at Bitcoin and historically what happens at a top. Bitcoin outperforms, then crypto catches up, then crypto outperforms pretty widely into a top. It's fair. That's kind of every cycle, right?
That's the historical pattern. Yeah, sure.
Yep. Well, this year I was looking around and you started to notice, and it was basically last year, that the market cap of Bitcoin really started to separate from crypto. Because it's telling you, and crypto is really Ethereum, XRP, Cardano, the other kind of top 10. Those market caps are going south. Bitcoin's just drastically going north because people recognize the real difference at this point. So I'm looking around. I was like, well, that makes sense, but what does that mean? And then I pull up and I compared MicroStrategy to Bitcoin. Same gap that usually you got with crypto. I was like, okay.
Right. It's instead of alt season, this has been a narrative as well. Like instead of alt season, it's LBE season or whatever word we're using, right?
Yeah. And so I was like, okay, well, just kind of let it go by. And then I got to looking at it, and then ETH goes on a tear, and it's still like 6% under Bitcoin. And Bitcoin Treasury company, I just use strategy, not to pick on them, but I just use them as the index, like they're best breed. Still way above. So I'm like, okay, well, if every cycle we have this narrative that's never going to end, and the worst case is never going to happen, and it so far has always happened, what potentially could happen here? And then I remembered some old George Soros stuff, and I went back and I did the research, and that was kind of the output of the paper. So it's less it was less so much hating on or being super skeptical about these vehicles. It was just like, hey, let's look at this and what are the real risks? Because people are blindly calling me and like, we just need to buy that thing. And so you have to think about, okay, well, what size, what percent allocation? If it did get cut 50%, how happy would you be? That's what, which is, you've probably done that 1,000 times in your own Bitcoin journey,
Yeah, especially mid to late in the cycle. It does put you in a really weird spot. Like, yes, you obviously caveat say, well, look, you've got to really like introspect yourself and say, look yourself in the mirror. If you bought Bitcoin and it dropped, 60%, would you still be comfortable with your decision? And would you be comfortable hodling for another 4 or 5 years to come back up into the green? And if you can't answer that, hand on your heart, and can't answer that, then you've got to sort of slow your roll a little bit and just maybe kind of small chunk it into Bitcoin. If you really want to take a position, just kind of slowly actually DCA.
Yeah. It's not the popular thing, but right. Because even in circles that you follow in or I follow in or whatever, there's always at least 80% of us that say, man, I should have bought more when it dipped, right? Everybody says they will, but it's like, oh, it's, this cycle, it's down to 70. I'm waiting for 40. I'm not buying until it's 40. And then I'm just picking numbers out of the air.
Right. But if we think about like that FTX bottom of like 16K, like late 2022, or the more recent one was this kind of tariff tantrum or whatever we're calling it at like 75K or so, was kind of, but the sentiment was so bad at that point that like, I think after you've been around a while, you sort of start to recognize those moments and you're like, correct, this is actually a great buying opportunity,
phenomenal
right?
time.
Yeah.
And that was, that actually, so I talked about the chart and the comparison of crypto and seeing that gap. I was kind of waiting on that. And that was a moment where I was like, well, okay, so I could go buy a Bitcoin Treasury, or I could just do it with myself with options. And that's what I did. I just chose that route again as an experiment to prove out the concept of what I thought was happening. And, it kind of proved it out. And I was like, okay, well, and I'm not saying everybody should go try and do that by any means, not financial advice here, but because we now have a lot of TradFi tools, it gives a lot of flexibility where if I understand Bitcoin or if somebody understands Bitcoin and you have another tool to do that thing, why am I going to introduce the principal agent problem? Where it's awesome that they can hoover up or you mentioned you're in one. I probably would do one if I was gonna, because that's an opportunity for the people that are running it to really make it up, and you just hope that they all do good by the investors. But the equity holders, when you look at the structures, if it doesn't go well, they're probably the first to lose.
And I think obviously there are risks, and of course there is certainly that element of like, and I understand that's an area where some people are saying, oh well, see, some people got in on the ground floor and now they're quote unquote dumping on retail and stuff like that.
But there's risk for that,
and exactly, like people are taking risk, they're trying to execute. The point is you're trying to choose a professional team, and the point, like the difference here would be, it's not just like a shitcoin ICO, people getting in to dump on retail. Here, I believe there's a sustainable, arbitrage for like from here till hyper Bitcoinization. I believe these public companies can do things that you and I as individuals can't do, either because of access to that level of capital or leverage, or it would just be technically and very professionally difficult because maybe not everyone knows how to go and do options and whatever. These companies, I think, can help execute this and make it accessible for people. And I believe part of the case is to do this in different jurisdictions around the world. And so that's why I believe it's a real edge. Put it that way. I think it's a real edge, and that equity holders can participate in such an edge. And it's not just kind of insiders are the only ones who win here. Like I think equity holders who buy into these and have a long view with a professional team, I believe it'll be a rising boats kind of situation.
Yeah, and I think long view is that's the disconnect. So you're on the ground floor, you're doing it, other people are on the ground floor, other people are doing it. I don't buy that as it's like the people say, well, you got in early in Bitcoin, so you don't, well, there was a risk to do that. It was riskier then than it is today, right? So the risk is going and setting up one of these things and fighting through the legal and the different tax and the different jurisdiction. Like it's a big risk, but everybody's got to take risk at their own level. But that was the one thing that stood out as I started this a couple of quarters ago. If you listen to what Saylor says, and the reason why I keep bringing him up is just because the information is there, it's easier, it's tried and true. So why not try to learn from the best if you're going to do it, rather than chase one of these smaller ones that maybe doesn't have the same expertise. His time frame, and I assume anybody that's putting one of these, for most people that are putting one of these together, is, I mean, I think he says 20 years. And I think that if you ask me, do I think Bitcoin is higher or things are better that are tied to Bitcoin in 10, 20 years? Absolutely. Do I think so in 5 years? Most likely. I mean, some things potentially could go wrong, but I think Bitcoin's higher, right? And so then he steps it down as like, okay, if you look at all the debt structures and the issuance, it's about 6 years. I think he might say that in there somewhere. And, if you think about Bitcoin, let's just say you took 100% of your cash in 2017 or 2021 and put it in at the peak. 6 years later, you were positive. Now, 3 of those 6 years are pretty brutal, and you go to the depths of those bears. Even though you're confident that they come back, you're kind of wondering, is this the time that it doesn't? That would be the risk with treasury companies. That, let's say, if we look at a market that Bitcoin is very much like, gold, it played that role up until Bitcoin was created, and Bitcoin is taking on that role and taking over that role. From 1981 to 2008, it never made another high. So 27 years. So I think the question as an investor, not somebody that's starting one of these or participating in management of one of these, but from a person that has access to the equity or the preferred or the convert or whatever, you have to say, okay, is this yield or is this multiple, this MNAV that I'm paying, if I go through a 3, 5, 10, 27 year period where the underlying never makes another high, am I going to be comfortable? And that's just an allocation decision. And so the reason why I point that out is to me, that's the thing that gets lost in, you just buy as many treasury companies as you can, and we're all going to get rich. I think the idea that everybody's going to get rich has changed in the last 2 years, and a lot of the fiat brain, is what I like to call it, has seeped into Bitcoin, where kind of the core ethos was, yeah, sure, we're here, everybody's here, everybody's interested in making money, but that wasn't the primary reason what brought them to Bitcoin. That was sort of the thing that they were running from. And now it's become like, how quickly can I multiply my stack versus let it grow?
Yeah, so I think we can't deny that NGU has been a big marketing factor, as long as Bitcoin, almost as long as Bitcoin's been around. Every cycle has kind of been driven by that. No matter how many podcasts and books and whatever we can talk about the ethos and the decentralization and the self-sovereignty and all these things, none of those really pull in as many people as the NGU. The best you can do, the best you can hope for is that like someone comes for the NGU and then you're able to sort of teach them some of the values of like why you should self-custody and run your Bitcoin node and all these things. So that's kind of how I'm seeing it. But I guess to your point around like, could there be a long time where you're underwater or down from the high? I think, to me, it just comes back to, do you believe this time is different with Bitcoin? Like, as in, is Bitcoin truly different? And I think you and I probably do agree that Bitcoin really is different this time. And so even if we do have a bear cycle, I think it is really going to come back. I think I'm curious to get your view. Like, we are kind of, some people like the power law, some people don't. I like it. I think it's an interesting.
I think it's legit.
And we're kind of sitting about on the power law now. Like, we haven't even hit the real euphoria phase yet, I would say.
Correct.
So, like, I would say, if anything, it's like Bitcoin is just being adopted over time.
Yeah.
And it's just kind of growing on this power law for now. Now, maybe, who knows, maybe end of this year or next year, or who knows, like we start to get into that real euphoria. And then at that point, it is going to get really wild and crazy. And you're going to start seeing like, like in 2017, we saw one company renamed to like Long Blockchain Iced Tea or something ridiculous. Like, and they had a pop just off that, just renaming to blockchain
AI,
in the name.
just put AI in your name.
Right. Yeah. So we're gonna see all that kind of craziness. But the point is, if you are looking at who is a professional and trying to professionally increase BTC yield and do the right actions to responsibly take a small amount of leverage to increase the returns, I think that's going to be the differentiator, isn't it?
Yeah, and I think if you look at like the debt ratios, the only reason, again, Saylor talks about it, I don't follow all the other ones. I think it's 10 to 20%. Well, okay, the debt ratio of a household, as long as it doesn't get over 30% with a mortgage, you generally don't run into financial problems. If you get over 30%, meaning your mortgage payment to your income, to your take-home income, and that's a stretch these days because of where rates are and home prices. But at some point, you're probably going to run into a tight situation. So if you look at it from that perspective, at 10 to 20%, that debt ratio is totally manageable.
Yeah, and as I look right now, strategy.com, their debt over BTC NAV is 12%.
Yeah.
It's very low. And so now I think there's kind of a more advanced conversation about what exactly does it mean in a preferred shares future, where if they start doing a lot of preferreds, then maybe that's really where the kind of the leverage factor comes in.
So that's what I was going to say. So we live in a fiat debt world where it's like that debt relative to revenues is high, and that's the leverage. But what is definitely different is the leverage that's being taken, at least in that case, is equity leverage.
Right. It's a balance sheet aspect.
Yeah,
it's the balance sheet side of it, not the income statement.
It's the opposite. So if you have, again, my world, most people are equity holders. They might hold some bonds. They might hold some other things, but they're not doing exotics. They're not doing commodities. Some of them do Bitcoin, but it generally is like, oh, I can do an ETF. Okay, I don't have to do on whatever exchange, River, or whatever, which is not hard, but just meet people where they're at. And so they might say, well, I'm going to buy Bitcoin. I'm buying whatever Bitcoin Treasury company. Well, you're really buying levered equity. And when euphoria goes too wrong in one direction, so it's going to track Bitcoin at some multiple, but we know that Bitcoin typically falls, then that multiple flips on its head and works in the other direction.
Yeah.
Because that's where the leverage is on the equity side. And that's just a volatility arbitrage. And that actually is pretty smart because you're taking volatility in one market, using it to create something in a different market. And
Right.
we've not, I mean, you could do that at early days of mortgages, but you see after you do that for a couple of decades, what happened. So I do think MNABs compress. You have some kind of bear market. Some of these start to struggle. You'll find that some of them were levered in the opposite way, in a debt way and not an equity way, or they were both, which would double whammy it. So I would imagine just like sitting through 2008 and these mortgage companies, banks come in and they pick apart and get the good stuff. The other part goes BK. Different. We don't really have the securities yet, but maybe some of these preferred just get annihilated. That happened in 2007. And you could literally go in and pick these things up at 25 cents on the dollar. Not saying that now, but you'll have consolidation and
You can see mergers and acquisitions activity even in the Bitcoin treasury company
in that space. And then in like a bull case scenario, once that classic, grift that runs the hype in like the 1920s treasury companies or Panic of 1907 with treasury companies trust companies, or the oil boom in the 1890s and 1900s, which was trust companies, where you saw trusts were like banned from doing business and they're brought back for Bitcoin to do this collateral asset that people understand the value, but we hadn't had financial products around it. So once that happens, the bull case is that whatever arises out of that rubble, assuming that were the case, becomes the 21st century bank, which maybe they end up replacing JP Morgan, Goldman, Bank of America. I think that's a stretch, but those big brands might go start buying treasury companies. I could easily see, BlackRock, especially since they're already involved, doing that. Maybe, I'm sure right now regulations are tough, but what would really be innovative is if instead of you having to take fiat interest, you could take Bitcoin interest. So you could buy this equity or this preferred, this traditional market thing and receive in kind actual Bitcoin or PIC, and that's sort of what BlockFi was doing. Now they were just doing traditional margin business. But you could deposit stable coins, receive Bitcoin or cash. On that Bitcoin, receive more interest in Bitcoin. I mean, River is kind of doing not that, but you can deposit
on the
cash,
USD account, getting yield
and get paid Bitcoin. So I think there's some really, I agree with you on that front. I think just timing with a lot of these coming in more towards when Bitcoin is at a traditional cyclical topping region. I don't think we're there yet. We haven't really seen that big thrust, but there's probably a better time. And I actually think some of these preferreds and fixed income instruments probably are front running bit bonds.
Right. And I think that's the conversation. I think Andrew Holmes did a talk on that at one of the BPI events, I think, in DC, kind of explaining this idea of like, what if the US government put out bonds but attach some Bitcoin into that, and kind of what would happen there. Yeah, I think it's interesting to see. It's possible. It depends how long this particular bull run goes. Like maybe if it goes out for another year or two, by then maybe there's more treasury companies in play with preferreds out, kind of issued and liquid and kind of active in the market. Maybe at that point, there'll be like a lot of people who are buying those preferred shares, and maybe that kind of dampens the bear cycle, like for all we know.
It totally could.
Right, because it could be like, as I'll give you an example. Let's say, it gets really frothy next year or whatever, and people are like, it's 300K, Bitcoin 300K. They're gonna rotate some of their stuff into like Stretch and say, okay, I want I'm just going to rotate into something that kind of is USD denominated, but pays me 9% a year, you know? And then MSTR on their side, they're going to take that income and buy Bitcoin with it and sort of use their kind of structure of their longer term balance sheet to sort of weather the storm a little bit and pay out this 9% on stretch as an example, while those individuals are able to kind of what's the word, flip around between these different the
rebalance capital structure. They're just able to move. I mean, again, I'll go bull case here because, you know, I wrote this. I think the paper that I've just put out is kind of the most interesting to me, given where we are in the cycle. In May, I wrote basically, here's the engineering behind, and here's how he's using traditional tools to make Bitcoin accessible to a large swath of the market that it will be years before they could buy it based on regulations, whether it be general financial regulations or like their own investment
rules or whatever,
investment committees, all that kind of stuff. So you could, forgot a second where I was going here.
Right, but I guess you were explaining a bit of the mechanics of how these things are, let's say, pulling forward the access, right?
Yeah. So look at Strife. So traditionally, a preferred pays you some rate. They're generally higher because they're generally riskier than traditional fixed income. They're higher up the capital structure. So Strife is the highest one up. And if they stop paying dividend, it's cumulative. So before they pay another, they have to go back and pay all the other ones, the past ones. But I can't remember. I think it's every year. But every year, if they stop paying that they didn't pay, they have to add 1% to the interest rate, up to a max of 18%. That's a unique feature that you don't. I mean, there may be some other securities out there like that. I'm not familiar with them, and I know in traditional preferreds they aren't. And so if I'm a fixed income manager and I really believe in Bitcoin, which I think a lot of people are finally coming around to that, and I can buy this thing and maybe I get it at a discount and I have that, it's not a call feature, but effectively, you know, a feature that juices it.
Right, that's the yield gives you increased yield over time if it's not paid.
Mm-hmm. Yeah.
Yeah.
So there's stuff, I mean, there's some unique stuff in there that I think is good. I'm more looking at Bitcoin cycle and trying to figure out where are we there? And then is this that euphoric thing that we traditionally see? And okay, let me put my hat on and see what would make sense on the other side. If you get some kind of drawdown, what would make sense? Because a lot of times investors will wait for the event to happen and then go try to figure out what's worth
happened?
Something.
Yeah. What you're trying to think about, well, how does this break down? Or what does it look like, right? Like, as we said, it likely looks like MNAV compression. It likely looks like, maybe some of the hype is fading, or maybe it's a little more difficult to get capital. Like for these treasury companies, maybe they can't get loans and funding as easily as they could in the hype bull run. And maybe just less retail interest, right? Like, I guess the quote-unquote euphoric kind of retail hasn't shown up yet. Maybe it does, but then eventually when they go, then that's kind of where it will come down to which of these treasury companies has a sustainable balance sheet, which of these has taken on good credit terms, not bad credit terms, or like structured things appropriately. There may be M&A activity, as we said, like maybe it's like a Pac-Man game. Some of the treasury companies may start buying the smaller ones, like maybe one of them has a higher MNAV than the other, and it's accretive to buy that other one, something like this. I mean, all these things are possible.
Yeah. What is kind of just my question, throwing back to you for a second. Obviously, Bitcoiners love Bitcoin, want to do anything, build and see Bitcoin grow. But what, from your side, what's most interesting to you in the treasury company space, and sort of what you're looking most forward to doing, being a part of one? And obviously, there may be some things you can't say, so you can leave that out. But
well, I think part of it is just like watching things that are evolving very quickly, and I think the more recent understanding that most people are coming to is this idea that, okay, maybe convertible notes are maybe not the long-term play. Maybe it's seen more like it's about getting to the stage where you can have preferred shares and have a range of them and different jurisdictions, different styles and things that can be out there. I think there's also opportunities that these treasury companies can do things to help education about Bitcoin in general, or maybe they can help things like funding Bitcoin development or things like that. Like there are elements that I think these different treasury companies, they'll try to differentiate in different ways based on whether that's the jurisdiction, the sector they're in, or whether they have like an operating business. I think they'll all try to differentiate in different ways. So I'm just kind of excited to see how those things go. But yeah, I think the other big factor is just like, maybe it's like a branding and education aspect, right? That people, maybe they're not as willing to just go and read about Bitcoin itself, but maybe they'll go and they'll go and learn about this particular company. And as part of that, then, okay, now they're going to, after they've sort of become an investor in that company, now they're going to sort of take that rabbit hole journey that many of us have taken in the Bitcoin world of like, listening to podcasts, reading books, and, talking to people, or going to a Bitcoin meetup, going to a Bitcoin conference, and these aspects to sort of grow the broader, let's say, movement or communities, let's say, around the world. So I think those are interesting ideas, and who knows in the future exactly where this goes. Like, because some of these treasury companies are kind of explicitly saying, yes, we're going to try to do financial services, right? Like if you look at Jack Mallers with 21 or XXI.
Yeah, they're going to lend.
Right? They're explicitly saying, look, we're going to do the treasury play stuff, the balance sheet stuff, but we're also going to do being like a Bitcoin, making Bitcoin products and services. And so we'll see, maybe they differentiate in other ways of actually offering some kind of Bitcoin loans. And whereas, let's say, Michael Saylor with MSTR is saying, no, we see it more like our role is to do, the preferreds and to not go into that particular aspect.
Yeah, I mean, he's taken the easier route, which depending on how you look at it, smarter or not smarter, right? Because he's using something to meet people where they are today. Whereas Mallers and those guys, while they might actually completely innovate and change the world of finance, it's a lot heavier lift to say, hey, one thing that's missing, we talked about the inflation and the debasement. If you calculate a real rate, you need a nominal interest rate, right? Because it's nominal interest rate minus the inflation, and we don't have one of those in Bitcoin. And the closest that you can get is maybe like an Unchained. And then that kind of matches Saylor's 29% a year. So if you're at 16 and 13, that's 29%. But if, say, Cantor and Mallers and those guys actually do real Bitcoin loans, then you have a real rate, which can tell you, just like in fixed income land, can tell you, should I be holding this asset or should I be holding something else? Now, I think we all kind of believe that Bitcoin is that thing you should hold for a long time, and you should ride up and down and kind of DCA or put in whatever your particular risk tolerance. But from a capital markets perspective, you can't build a capital markets without a true base rate on that instrument, and we don't have it. I mean, Saylor's building out that credit curve, but it's really a fiat credit curve.
Right, it's fiat denominated, at least for now. Maybe in the future, there's something different now.
And I'm sure a lot of that, like you say, when not sleight of hand, he's taking the easier route, but if you can go do the thing you want to do and get 90% of the way there, I mean, you see it all the time. Banks let fintechs, fight all the regulation, break their way through, do something really innovative, and when they finally get there, they go buy them for $2 billion.
Right, or they just kind of copy the model and do their own, copy the feature, and it's like how tech companies sometimes lived in fear of Google copying their feature, and then
they just come buy you.
Yeah, or they buy you, or acqui-hire you, or whatever. Yeah. So lots of things.
There was one other thing, just from kind of, again, the skeptic part, and I just saw it recently, just flowing across, and I can't remember who, but it was kind of a part of that earnings call or after the earnings call, just, there's a lot of news that comes out. And there was this, oh, Strike's going to get the K, I think it was, maybe wrong, but I think it was the K, going to get to it's worth $1,000. And, part of the reflexive hype narrative is throwing some price out there and then getting everybody, it's the Wall Street bets. If we all get behind this thing, it's going to go. That is the reality. That's the Soros thing. But if you read a little bit further into the prospectuses, $1,000 is the ability for them to call that in. There is $1,000 is the price for which things can convert. And so if you can get the price to certain points, it gives you, the entity, a lot more flexibility. That could be good, could be bad for the investor. But for the entity, if you think about at the end of the conference this year, the pitch was like, go be a company because you as a company have a lot more power, clout, whatever, than you as an individual. And I don't disagree with that by any means. But when I see some of those kind of signs, like, where does that number even come from? But then I'm reading through the documents and I see in the document, I was like, okay, well.
Yeah. So as I understand, this is like one of the preferred shares has this convertibility aspect. And so then it's like above a certain price, it can convert into equity. So it's, I guess, somewhat dilutive to the common shareholder. But the point would be, well, MSTR, the entity, got their money up front on the front side. Yeah. So they were able to buy Bitcoin with it. And
but if you're just, I'm just going to buy MSTR, and it peaked months ago, it is down, Bitcoin's up, and you're like, why is this thing not performing? Well, because the thing that you should have bought was that specific preferred. And maybe you're just an equity guy, not a fixed income guy, and you're like, well, I don't want this thing with yield on it. I want the levered MNAV play. And so because you didn't understand the nuance of the different tranches, you bought the wrong thing, not knowing, just getting caught up in the hype.
Yeah, I mean, certainly people can get caught up in the hype. I think that's, nothing new. We've seen that many times before in Bitcoin. And I think the other interesting thing that I'd just add is that, yes, this, I guess, if we think post FTX bottom, this broader kind of cycle, we've had these kind of mini cycles with some of the treasury companies, right? So they've been up and down, and they are arguably, they are more volatile than Bitcoin itself. And so there are times where they're down, 40%, 50%.
70 right now.
A lot from the high. But then later in the cycle, after Bitcoin takes another run up, they go up even harder, and then we do it again and again, and we're just, until, who knows, right? If we hit like a euphoric Bitcoin top, and then that puts in the overall top for the cycle, and then we do it all again. Yeah. So it's just kind of like, if you're going to do this, you need to be ready to ride the volatility, right? And some people, they want the volatility, right? Because they feel like, I guess it's a natural thing of like, I missed Bitcoin in the early years, so let me try to buy this volatile thing that can outperform. And so I guess that's part of the mindset for some people. And so I guess you just have to, if you're buying, the common equity of these treasury companies, you're in for a volatile ride, especially if they're a smaller, like MSTR is one thing, but to buy the smaller ones, they are more volatile, and just be honest about that.
Yeah, that's a great point. It's just like early Bitcoin. Do your homework, right? You can't take somebody else's story. You can listen and get educated. And I think to your point on education, the whole sound money, what is money, what Bitcoin fixes, that education play is not done, but by and large, you can't take that to somebody and them be like, oh, that's something new. You just blew my mind. Whereas the Bitcoin Treasury company education component, you can still do that because there's different unique ways that it builds Bitcoin into the capital structure.
And I'll just add that some people don't care until they're personally invested. And so they won't care about learning about, Rothbard and Mises and all these people telling us about sound money until they've kind of got some skin in the game, and whether that's BTC in their cold card or BTC on a custodial exchange or a Bitcoin ETF or a treasury company, until they've got a little bit, they're not going to actually go down the rabbit hole. And I think this is it's like a new top of funnel for certain people who they weren't going to come in the principled, cypherpunk, no KYC way. They're going to come in through some of these things that are on their stockbroking platform.
Well, I mean, I would say just from my side of the business, I can talk about it till I'm blue in the face. For people in my shoes, on my side of the business, not the client side, but 50, 60-year-olds that are like, don't touch that, it's too risky. But you go through a period like February to April this year, world's falling apart, tariffs are going to blitz everything, and their trusty bonds just went through the floor. And then Bitcoin, I mean, everybody knows gold, but most of them believe in that. It's just a standard, narrative in our side of the business. But they see Bitcoin going through the roof, and it's been doing it for 15 years. And then they see strategy or whatever, also in that, wait a second, it, like you said, they finally had their moment where that one thing they had been hanging on to that was going to save them didn't save them. And so they were willing to hear the message of debasement, the message of the problem with inflation. And then they were even more willing to go get at least a little bit of education to see, should I really actually be putting myself, or exposing myself to these other tools, even if it's not huge, because they're working and I never thought they would.
Yeah, I think you nailed it there. Like, I think there are a lot of people slowly waking up over time, right? There are some people who woke up in past cycles and, in the cycles to come. I think there will be bull and bear, and we have to be ready for that. So I think it's a great spot to finish there. So listeners, make sure you check it out. I will link the Substack and Kane's X account as well. Kane, thank you for joining me and sharing your thoughts on Treasury companies and, some of the insights on what you are seeing with your customers also.
Yeah, thanks, Stephan. I enjoyed it. Happy to come on and look forward to future conversations, but it was a fun one.